Hey folks, welcome back to the channel. It's Liquid here, and let's talk about the real estate industry and why the housing market is continuing to stay afloat despite such aggressive tightening by the Bank of Canada. We'll look at what this means for homeowners, what this means for renters, when is the best opportunity to buy real estate over the next few years, and it's not going to be right now because prices, I think, are still going to fall further from here, as I'm going to explain. First, let's take a look at where home prices are right now. They've definitely come down from the top. This is a chart of the benchmark Ontario home price, and it's come down about 15-20%. But a lot of people are wondering, if interest rates have gone up so much over the last year, how come prices haven't dropped further? We went from pretty much zero all the way to 4.5%. Mortgage rates went from like 2% to 6%. And that translates to about 30 to 35% of a buyer's purchasing power getting wiped out. So a year ago, if you could afford like a $600,000 mortgage, now it's more like $400,000 or $450,000. So technically, home prices should actually fall by more than what we're seeing so far. The last time interest rates were this high was back in 2008, and as you can see, prices were much lower back then. Pretty much Ontario homes were 1/3 of the price as they are now. So what's going on here? Why haven't prices come down more to like 700 or 600? Well, one reason is because it takes time for interest rate changes to work their way through the housing market. Because the people who are on fixed rate mortgages only renew their mortgage once every 5 years. So only about 20% reset their mortgages every year. The rest don't have to make any changes to their payments. So even though mortgage rates are 6% or higher today, a lot of people still have like 2 or 3% mortgages locked in, and they're not going to be affected for some time. Now, with variable rate mortgages, the interest on the loan does change. However, the actual monthly payment, which is actually what the borrower pays, doesn't change most of the time. Here's an example of BMO's variable rate mortgage. Let's say you get a mortgage for $400,000 and the interest rate is 4%. Well, your monthly payment is going to be $2,111. And the light blue area is how much of the total payment goes towards interest. And then the darker shaded area is how much principal you're paying down on your $400,000 initial loan. And what happens when interest rates increase, let's say to 5.5%, so up 1.5% more? Well, as you can see, your monthly mortgage payment stays the same. So you don't really notice anything. Your household budget, your cash flow, it doesn't change. What simply happens is that more of your payment goes towards paying the interest, simply because the interest is higher, and then less of it goes towards paying the principal. So your mortgage balance is going to go down slower. So even for variable rate mortgage holders, the payment doesn't change. So that's why you're not seeing a lot of distressed sellers out there. Now, at some point, if you have a variable rate mortgage with a fixed payment, the interest rate may go high enough that your entire payment is going to go towards the interest payment and nothing will go to your principal. In fact, if the interest accrued is even higher than your payment amount, then what the banks will do is actually add on to your mortgage balance. So instead of the loan amount going down every month, it's actually going to go up. And at banks like TD, you can go up to 80% loan to value before it is capped off. So how the banks are able to compensate for your mortgage balance actually increasing is they just extend the amortization period. Instead of getting you to pay more money in order to cover the interest, they'll just give you more time to pay off the mortgage in the future. Here's a look at CIBC's amortization schedule over the last year. In Q1 of 2022, so a year ago, most of their residential mortgages were 20 to 25 years or 25 to 30 years in that category. But a year later, in Q1 2023, the most recent data, 27% of their mortgages are now 35 years or more. Typically, banks originate mortgage at 25 or 30 years. They don't like to amortize it for too long. So the reason why there weren't any 35 years or more last year, and now 27% of their mortgages are 35 years and over, it's pretty much all because the payments that homeowners are making on their mortgages do not cover the interest payment, so the extra interest gets added onto the loan amount, and they are given a longer time to pay it back. It's basically like instead of dealing with the higher interest rates now, they're just kicking the can down the road. And of course, because of this, as long as those people are still gainfully employed, it does not affect their ability to service the mortgage at all. So why would anybody sell? Now, there are a couple of banks in Canada that instead of offering variable rate mortgages, they have adjustable rate mortgages. And with these, your mortgage payments will actually change based on the Bank of Canada's interest rate movement. However, most homeowners with loans do not have these kind of mortgages. But even for the people who do have adjustable rates and they are seeing higher and higher monthly mortgage payments, well, they're probably not going to sell their homes either, because even though they're struggling to make mortgage payments, they will likely struggle more if they sell their home. Because first of all, these people are most likely the ones who bought their home in the last 1, 2, or 3 years. And if they were to sell now, they'll probably get less than what they originally paid for their home. Plus, they know there's not a lot of listings out there right now. So even though interest rates have gotten much higher, prices have not actually come down enough to help affordability. So if you buy a home now with these higher interest rates, your mortgage payment is still going to be higher than if you were to buy like 1 or 2 years ago. And people have to live somewhere. So if they sell their home now, they'll have to move into another home. But if they buy another home when there's not a lot of inventory, then they'll probably have to compete. And maybe the new place that they buy is not as good as the current one they have. Plus, as everyone knows, there's a lot of transaction costs and fees and property transfer taxes when you trade real estate. So it's not really worth it. Like, it's better to just try to cut your spending in other areas, but still make the mortgage payment so you can still keep your home. Now, what about renting? Because you can always sell and rent. Well, that's not going to help you much either, because according to rentals.ca, over the last 2 years, starting from like March of 2021, rental prices have just been getting more expensive. At the beginning of 2021, it was $16.89, and then last year in January, it went up to $18.04, and then just recently, it's at $19.96. And this is the average rental price across Canada. So, of course, each city is going to be different. I mean, that's almost like a 20% increase over the last couple of years. So, you could sell your home and then go rent. But I'm not sure if renting is cheaper than continuing to pay your mortgage right now, because you have the same problem in the rental market. There's not a lot of inventory. In Vancouver, for example, year over year, one-bedroom units went up 24% in price. In Toronto, up 20% in a year. And people who used to look for two-bedroom homes are now forced to maybe look for one-bedrooms, which is why the one-bedrooms are really popular right now and have been growing the most quickly. And then, of course, the question is, okay, you move into a rental, but then at what point do you then go buy another property? And if rent continues to go up like this, then if you rent for the next like 3 or 4 years in a large urban area, your rent could be like 30 or 40% higher by then. Meanwhile, it's not likely for your mortgage payment to go 30 or 40% higher, because it seems like the Bank of Canada has pretty much exhausted their interest rate hikes, at least for the foreseeable future. And the affordability issue, I think, is only going to get worse, because over the last few years, Canada's immigration policy brought in around 300,000 people each year, last year being 391,000. However, there's not enough homes to house that many people, and over the next few years, it's going to get even more crowded, because the country's immigration minister, Sean Fraser, wants 465,000 people to come to Canada this year, even more at 485,000 next year, and then a full 500,000 in 2025. So that's almost 1.5 million people coming into Canada over the next 3 years. That's about 4% of the population we have right now. Plus, if you include Canada's birth rate, which is about 400,000 each year of new babies being born, if you add up all of that, and even if you subtract the death rate in this country, you're still looking at a pretty sizable population growth estimate. And the majority of those people are going to be in large city centers. And right now, there isn't even a plan for building new homes within that short of a period of time to house that many new people. So I think housing is going to only become more unaffordable over the next few years. And I wouldn't be surprised if the average listed rent goes up to like $2,500 by 2025. So if that's the case, then is renting really a good choice? If you're not going to rent and you're also not going to want to buy a new place, then the only other option is to just try to make ends meet and do whatever you can to make those higher monthly mortgage payments. Even if you have to eat mac and cheese, cut your cable and other subscriptions, and walk to work instead of driving like how people used to do it. So even mortgage holders with adjustable rate mortgages that are making higher monthly payments now than before are willing to do whatever it takes to not sell their homes. So that is why there's just not that many distressed sellers out there. Inventory is very low. There's just not a lot of new listings out there for buyers to choose from. And as such, activities are really low as well. Only 1,000 homes were sold in the Greater Vancouver area in January. Last year, there were over 2,000. So because supply is down, there's not a lot of inventory, and transactions are down, it's hard for prices to fall. You don't get a crash in the market unless you have a lot more people putting their houses on the market for sale. And right now, there just isn't a motivation to do that because of how mortgage payments work relative to what interest rates are doing. The only way we're going to see like a 25 or 30% crash in the market to justify the really high mortgage rates that we have now is if the country's employment numbers take a hit. So if we see a lot of layoffs or if the unemployment rate goes up a lot, then the higher interest rates is going to cause businesses to tighten their spending. That's going to lead to less hiring, maybe layoffs. And if someone doesn't have a job anymore, that's what's going to make it tough for them to make the mortgage payment. And that's how you get motivated sellers. And that is going to lead to lower housing prices. But it just might take a year or so before that happens. So if the labor market takes a hit, then we could see a rapid, like 20% fall in the real estate market, like from current prices. But if employment stays strong, then the same thing will happen. Prices, I think, will still go down quite a lot, but it just might take a year or two for enough renewals to come up so that the higher interest rate environment now can be fully felt in the housing market. But before that happens, I think the Bank of Canada, just like the Federal Reserve in the US, all central banks are going to cut interest rates again. Because if they leave interest rates at current levels, like at 4.5% in Canada, and they leave it for 5 years to give time for all the mortgages to renew at the new higher rate, then we're probably going to see like a 40 or 50% crash in the real estate market. And I don't think central banks want that to happen. So I think rates are overly extended right now. The only reason they haven't cut yet, because nothing has happened so far that's bad enough for the Bank of Canada to realize that it's broken something and cut rates. But eventually that event will happen and they will realize that they have to lower interest rates. It's just right now the economy isn't suffering yet. But here's why I think interest rates are too high. Last time they were here, as I mentioned, 2008. Well, back in 2008, Canadians had about $0.8 trillion of mortgage debt. This was the outstanding debt held by institutional lenders at that time, 0.8. And just a couple years ago, this number was at 1.71. So it's probably even higher than this now. But even if we took the latest number here from a couple years ago, 1.71, and we divide it by the amount of mortgage back in 2008, which is 0.8, then that means Canadians now have over twice as much mortgage debt as we did back in 2008. And when interest rates went up that high back in 08, it crashed to the ground because something was broken. So we have more than twice the amount of debt as we had back then. And it's not only for residential mortgages, corporations and governments also have way more debt now than before. So you can have higher interest rates for a short while, but there's no way you can stay at 4.5% for the next 2 or 3 years. Simply because the amount of debt will just crush the economy. Now, if you are in the market to buy property anywhere in Canada or even in the US, of course, you're probably looking for the best time to buy, which is when prices have bottomed. And although nobody knows when that's going to be, there are some clues that can help us figure out a rough timeline of when the lows might be in and what signals to watch out for. Like I mentioned, a lot of it is going to depend on the employment situation. If unemployment spikes up like in 2008 or even in 2020, then we are probably going to see a pretty fast crash of the real estate market. Because if people don't have jobs, they can't keep paying their mortgage, so they'll be forced to sell. That creates more inventory, making it a buyer's market because sellers will have to compete and try to attract buyers, whereas currently multiple offers are still common. But if we get some kind of soft landing and employment stays relatively stable, we don't get like a pop up in the unemployment rate, then this could be a drawn out event, like I was mentioning, where you have the next 1 or 2 years where interest rates come down a little bit, but central banks are not forced to slash them back to emergency low levels. And as homeowners have to renew their mortgages over time, some of them will not be able to adjust to the higher interest rates, so they'll be forced to sell. And that will work its way through the housing market. So we're going to see cheaper prices, but that's going to take a longer time, like maybe over the next 2 or 3 years. And one correlation we can sort of see throughout history is how the Bank of Canada's overnight lending rate correlates with real estate prices. So this blue line is the interest rate over time. And you can see recently there was this massive move up, which puts it at 4.5 right now. Now here's another graph showing the home price index. And this is measured in percentages. Basically above the zero line means home prices are increasing, and then below the zero line, it means the prices are decreasing. And this goes all the way back to 2006. We can see in 2018, 2019, the real estate market across Canada took a little bit of a dip, but then came back. and it grew pretty strong into 2021. And at the start of 2022 is when it began to fall. But remember, even though it's falling, it's still above the zero line. So that just means prices are increasing at a slower rate, but prices are still going up all the way until the zero line. And that's when prices are actually falling. And the lower these bars get, the faster the prices fall in percentages. Now, what I can do is overlay the Bank of Canada's interest rate over this MLS home price index. We can see that whenever there's an increase in the interest rate, like here, it corresponds to a fall in the real estate market. But the timing is not exactly aligned. There seems to be a lag between when the interest rate is taken up and when home prices fall. And the lag is somewhat dependent on how much interest rates are rising. So, for example, back in the mid 2000s, we had this interest rate move that went from, it looks like 2% to 4.5%, so about 2.5% increase. And the last increase was right over here, just before 2008. And the bottom of the housing market was over here at the beginning of 2009. So that time difference between when these two things happened was about 1.5 years. Now, the next rising interest rate cycle started in 2010 and it stopped going up right over here. It looks like right before 2011. And because that was less of an increase, like just 1%, the bottom of the real estate price movement happened just a few months after. And then the next interest rate increase started in 2017. And by the time it finished going up, the last rate hike was just before 2019. That was in total a 1.25% move. You can see this staircase going up here. Each step represents a 0.25% increase. But anyway, that was a larger increase than the previous rate hiking cycle, but not as large as the one before that. So the real estate market bottomed about 6 months after that, right over here, at about May 2019. So a couple of observations. One is that the larger the interest rate is raised, the lower the home price index falls, which kind of makes sense because if you raise interest rates by a little bit, you're only going to affect the real estate market by a little bit. But if you do like a 2.5% hike, then it should make sense that prices are going to go quite a bit lower, all the way down to minus 10% there in that. It looks like the third or fourth month of 2009. But this interest rate hike here, it's pretty small. So home prices were not affected too much. It actually didn't even go into the negative. And then the second observation is the larger the interest rate hike, the more of a lag there is between the end of that hike and when the housing market bottoms. And if I add these gray bars in here, it's just easier to see. The width of these gray bars represents the length of time between when the last rate hike was done and the lowest point of the home price index. And the larger the increase, the wider the gray bar is. So what about now? Well, we just had a 4.5% increase, which personally I think is overdoing it. So I do believe we're going to see this interest rate be cut at some point. But because of this massive move up, using the observations that I was just talking about, I'm going to say that prices have definitely not bottomed yet. In fact, this year-over-year percentage change, this home price index, I think this is going to continue falling. If I draw a trend line from the top here to the bottom, I think that's going to continue to fall. Maybe to like minus 15%. I mean, we've already gone past minus 10%, which is further than the tightening cycle in the mid 2000s. Right, so far, this theory of the larger the interest rate increase, the further this HPI is going to drop, and it looks like it's already doing that. But how much further is it going to drop? Is it minus 15, minus 20? It's going in that direction right now, but it's hard to say when it's going to stop. But the other thing that we can take away from this, if the patterns that we've seen in the past play out again, then we're probably going to see a pretty big delay between when the last interest rate hike is finished and the bottom of the HPI. Like I'm going to use this gray bar here, and I'm going to guess that it's going to be at least as wide as in 2008, 2009, if not probably even wider. And the bottom could be somewhere over here in 2024 or 2025 even. So by looking at this, what I'm pretty much getting at is if you think this year in 2023, you can look for some good deals out there in the market, then you're probably going to find even better deals next year in 2024. So I believe the bottom of the real estate market in both Canada and the US is not going to be this year. I think it's going to be next year, if not in 2025. And one thing that I used before when I was buying real estate in and around Vancouver is to look at the curve of this HPI graph. And I basically want to buy at a time when it's going up like this, not when it's going down. because when it's going up, remember, prices are still falling. They're just not falling as fast. So currently, we're still seeing this downward projection. So I would definitely not be looking to buy any properties right now. And I think for the rest of 2023, these bars are going to continue to get longer on the way down. So I would definitely hold off. But eventually, just like this, the bars are going to reverse direction and go back up. And I would consider buying somewhere like around the 0 point there, because the 0 point is when prices go from falling to growing again. And you can even get in a little bit earlier than this, but definitely not before the bottom. And you can always tell because there are many months that lead out of the bottom. But if you want to be super sure, just wait until it gets to the 0 point again. So you do have many months of this leading indicator to tell you. One thing with real estate is that unlike the stock market, it doesn't move very quickly. So there will be signs like this where you can anticipate inflection points and prepare for opportunities to get into the market at that time. So that's essentially my outlook for now. I do believe interest rates are going to come down probably before the end of this year. It just depends on when the central banks realize that they've broken something. And once it becomes apparent, you're going to see rate cuts. Probably not back all the way down to like near zero again, but you could easily see it cut in half. If for no other reason than the debt that the world has now is just unsustainable at these current high levels. And because inflation has peaked, I think if central banks are pushed into a corner, they would rather have more sticky inflation than unemployment, because inflation hurts everyone's purchasing power a little bit, but unemployment will affect some people's livelihoods a lot. But I don't know, do you guys think interest rates have pretty much peaked, at least for this tightening cycle, and we're going to have lower rates by the end of the year? Or is the 4.5% Bank of Canada rate going to stay all the way into next year? The only thing I'm pretty certain about is the economy is probably going to get worse before it gets better, and home prices are going to fall lower before they start climbing again. But how bad can things get? I guess we'll have to see over time. Anyway, I hope you learned something new in today's video. Thanks a lot for watching as usual, and I'll talk to you in the next one.